So things in the Middle East are getting even worse than before. The chaos has spread well beyond Gaza or the Red Sea. We are talking about Iran and the US on the brink of an unthinkable escalation. Now, we've said before that the US has locked themselves in an endless loop of doom and destruction. President Biden admitted that the strikes on Yemen won't stop the attacks. Are they stopping the Houthis? No. Are they going to continue? Yes. There's now confirmation of this craziness spiraling out of control as well. It's not just the Iranian proxies that are threatening to strike back, Iran is vowing vengeance. US based attack in Iraq hours after Iran vows revenge for Damascus attack. It wasn't the US military that attacked Tehran's building in Syria. The blame is put on Israel, but it doesn't matter now. According to CENTCOM, missiles were raining down on the US base on Iraqi soil. This time there were multiple casualties on the US side, and we all know what that means. A retaliation from the US military is coming. It's another show of strength that the US is obliged to execute or just look weak. We have reached the point of an endless escalation loop. A ceasefire is what the Middle East wants, and until that is given by the US, these tit for tat vengeance strikes will only continue. This, of course, is making global inflation start to rebound across the world, especially in the West. Ships are being rerouted away from the Suez Canal, which is driving up the supply cost of virtually everything. Remember the airstrikes on Yemen? Well, the West is going in yet again for another strike. From Bloomberg, US UK airstrikes hit more Houthi targets in new escalation. Remember what Biden said earlier, the strikes won't stop the Houthis. The US and the UK, they are going after the symptoms when they should be addressing the underlying condition, which is the need for ceasefire. And this is going to push up fuel prices even more. It's not just container ships bringing you stuff from Amazon, but the big boys, oil and gas tankers transporting energy to the world. The cost of transporting fuel has gone up exponentially. It was around 20 grand a day to charter a ship to move oil and gas around. That amount has risen to over 50,000 or even 60 grand in some instances. That's a tripling of price because there's now a war premium on insurance rates plus a big shortage of ships available. And since you need at least 10 more days going around Africa, that's $500,000 more in transportation costs. That's at the very least. That amount is going to get passed down to the end consumers, you and me. So there's no telling how crazy this escalation can truly go. We have the economists declaring that Iran and America are closer to the brink of war. All it takes is one strike by the coalition on Iranian soil for whatever reason, then Tehran will get dragged into the conflict. We aren't at high intensity yet, but the stakes are building up fast, which brings us to the true determinant of the entire conflict. What Israel wants is going to push the region closer and closer towards a bigger breaking point. Israel wants to control Gaza post-war, and they rejected the Arab proposal for a two-state solution. Now, what's interesting is how this idea is backed by both the US and the Middle East now. We have the Saudis, the UAE, and Qatar all pushing towards a ceasefire. They will provide huge amounts of money to rebuild Gaza. And this is a good one, but it requires Israel to simply stop bombing them. The World Bank estimates over 60% of Gaza's infrastructure has been destroyed. So we are talking about billions of dollars at the very least. But here's the caveat. They want guarantees that the buildings won't be bombed into oblivion again. However, it will be impossible, guys. Israel wants security control over all land west of the River Jordan, and that includes the territory of any future Palestinian state. So whatever the Saudis are planning with the Americans, it won't work. It's another dead end, and the US military is simply the cleanup crew for Israel. And you know things are out of control when even the EU is calling for Israel to end the war. Instead of destroying Hamas, Israel is ceding the hate for generations with their strikes, says Borrell from the Eurozone. Yet admits that a two-state solution is the only route left to peace. What the EU is truly worried about is the state of their economy. Germany's economy has officially contracted in 2023. It has shrunk by 0.3%. And when the biggest economy in the Eurozone collapses, the rest of the bloc is in big trouble. A survey finds the EU is about to suffer their first recession since the lockdowns. Economists see GDP shrinking by 0.1% in the final quarter of 2023. That is just the lag effect of the Russia-Ukraine conflict and all the Western sanctions. The doom and gloom has already been baked into the cake, and the last thing the EU wants is a new inflation crisis in the Middle East. If the supply of oil and gas, especially LNG, gets disrupted, they will be facing a deeper industrial collapse. If we track the manufacturing PMI of the Eurozone, we can see how sensitive their industries are to higher energy costs. In September 2022, Russia cut away gas supplies to Europe. In December the same year, the G7 imposed price caps on Russian oil, and that caused energy markets to be split into two: cheaper energy for China and India and Asia, while Europe gets stuck with importing more expensive fuel. Just half a year later, thanks to high input costs and interest rates going up, Europe is deindustrializing. Manufacturing PMIs are deep in the red, showing massive contractions across the board. And with the Red Sea crisis escalating a month ago, the EU is on the brink of yet another industrial crisis. So you can see the urgency of Borrell to end the Israeli attacks. The Eurozone can't afford another inflation crisis in 2024. And sooner or later, Europe will have to tell the Americans to stop vetoing a ceasefire, right? And if diplomatic pressure continues, America will be forced to back a UN resolution or be truly isolated from the rest of the world. And speaking of an energy crisis, let's talk about the recent attacks on Russia's gas plant. And this is quite a serious issue because it affects the downstream export operations as well, their oil terminal. From Reuters, Russia suspends operations at fuel export terminal after suspected Ukrainian drone attack. And this is quite a serious attack that forced Russia to stop their exports. Once again, this is another hit on the global energy supply chains. When you knock away energy supply, it doesn't just affect Russia, it will also complicate supply side inflation as well. So we are witnessing a war that's escalating to energy infrastructure within Russia itself. Now, the West, of course, is afraid of these attacks, right? It could provoke Russia to strike back and, more realistically, trigger yet another energy crisis. But according to Ukraine's spy master, they will continue operating deep into Russia. There will be no stops to the sabotage attacks, and we can kind of expect more chaos in the weeks to come. Oil rises about 2% after the attack on Russia's fuel terminal. There's already a material effect happening on the energy markets. Russia accounts for 12% of the world's oil production and 13% of exports to the world. So if Ukraine decides to keep hammering away at Russian infrastructure, that's going to be a big game changer for the global economy, right? We can see the desperation starting to build up with Zelensky. He's waiting for the $60 billion from Joe Biden, which might never come. In a recent meeting, the Biden administration is all doom and gloom. They are warning of a Ukrainian defeat looming unless the money is passed. If Congress fails to authorize additional military aid for Ukraine in the coming days, Russia could win the war in a matter of weeks, months at best. And this might be a scare tactic to get the funding bill approved, but it still underlines the extreme fear that's circling the West. This has always been about financial attrition. It boils down to how long Russia or the West can outlast each other. By attacking oil infrastructure, Ukraine wants to cut away Russian revenue. However, it threatens to ignite a new energy crisis. Since the start of the Israel war in October, the price of oil has been dropping. Supply contribution in yellow has gone from positive to negative on the oil price. In other words, more supply is flooding the world than contribution from demand. The US and Venezuela are ramping up production, and that is countering OPEC's cuts and the supply fear. However, if Russian supply gets attacked enough, we could see prices start to rise fast. And this is how precarious the situation is. And with higher energy prices, we know what that means, right? Sustained inflation for months or even years to come. We have two conflicts that could directly escalate this insanity: the Middle East and the situation in Ukraine. Either one could plunge the world into a mess. The biggest risk is still the Israel-Gaza war. An escalation there could mean Iran getting into the fray, and then all hell breaks loose. Crude prices could hit $150 per barrel, global GDP will crash by 1%, and global inflation could rebound by up to 1.2% as well. But let's shift gears a bit and talk about China, right? I'm sure you noticed the headlines over the past few days. It's about a big sell-off in the Chinese markets and how investors are all running away. So far, Chinese and Hong Kong stocks have erased more than $6 trillion from their recent peak. We are now at the October lows in 2022, and it's a real concern for investors. Other markets like the US, they've all hit record highs, right? Even Germany and Japan's equities are staying strong. China has also diverged from other emerging markets like India. India has overtaken Hong Kong in stock market value, and that is a big shock considering Chinese stocks have led India for over 20 years. And this proves that the markets are extremely bearish about China as a whole. So if you're invested in the Chinese markets, you're probably reeling from the shock. If China's economy is growing, if they're getting cheap Russian energy, why are their equities collapsing? China's economy grew by 5.2% last year, and that's more than the US and Europe. But why are their stocks still down? And this is where we have to remember the basics of investing 101. The economy is not the stock market, and the stock market doesn't reflect what the economy is doing, not all the time. What affects stock prices is the flow of money. the amount of liquidity entering and leaving. And the big question we have to ask is simple. Why is liquidity leaving the Chinese markets? Why is money leaving Chinese stocks? Now, many reasons are contributing to this. It includes tensions between the US and China. There's also the Chinese government telling stockholders not to sell. That just had the opposite effect and is a big mistake that the Chinese government made. But if there's one primary cause, that will be China's refusal to launch massive stimulus. In other words, China doesn't want to increase deficit spending to prop up their economy. Investors, they see this and they freak out, right? There's no immediate money coming in, and that spells a longer road ahead for China's recovery. Wall Street, they are afraid of the real estate crash getting worse, which it likely will. In this chart, we can see China's property meltdown changing the entire landscape. In 2016, real estate accounted for 24% of their total GDP. But in 2 years' time, by 2026, property could drop below 16% of the economy. And as we covered previously, China is making a big shift to high-tech manufacturing. But as one sector is growing, Wall Street, they're all focused on real estate imploding. Then you throw in China's premier announcing in Davos that no stimulus is coming, right? That was basically the death knell for investors looking for easy returns in Beijing. So it's no surprise that money is flowing out of China and heading to places like the US where deficit spending keeps going up. So before you invest in Chinese stocks, it's key to understand this dynamic. This underperformance could last for months or even years because a transition towards a diversified economy will take some time. Now, personally, I'm increasing my exposure to Chinese stocks because I'm willing to wait and play the long game. It's only 5 to 10% of my total holdings, so I'm not betting the farm either. But here's why I'm long-term bullish on Chinese stocks. The valuations here are extremely tempting. China's stock market now has a record valuation gap versus the US. Chinese sell-off leads to record $38 trillion gap with US stocks, and this makes the China index 60% cheaper than the US market. Never before have we seen such a big divergence in valuations. A lot of money is piling into US stocks while investors, they are simply leaving Chinese equities. China's price to earnings ratio is only around 11, while the US is at 24. So US stocks currently command a big premium versus China. Investors are willing to pay much more for US equities because the money printer will never stop. Now, for me, the risk to reward is attractive enough, and consider what our Arian, the famous economist, had to say about China's big pivot. China is transiting to a new economic model, one of high quality, less dependence on the outside world, and more reliance on domestic consumption. In other words, China is going high tech and they are effectively decoupling parts of their economy. So, if you have the patience and believe that China will succeed, you might want to take a look. But if you think it's over for China, or if you want to win big tomorrow, you don't have the patience, Chinese stocks will simply frustrate you. It's best that you stay out. But let me know what you think in the comments below. Is it doom and gloom for China? And will the Middle East conflict escalate even further? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.